Hi, Gary Klaban here. I'll see many times a mortgage that needs to be refinanced, and I'll ask, why not? What comes back many times is, hey, closing costs are too high, or my lender doesn't want me to refinance, or, it's just too much time and hassle and effort to do that. And though that may be true, you might want to consider that if there's some big savings. So why would you do it? Well, number one, huge savings on interest expense over the long term. Number two, you might have private mortgage insurance. Nice to get rid of that because that can be very expensive. Number three, you might need cash out to pay other debt off or to use for home improvements. So what conditions would you do this under? Well, you look at the monthly savings, you look at the closing costs, and you divide in to see how many months before you break even. If it's a year to two, probably makes sense to do it. How about the interest rate? Even at a 0.25 percentage point lower, could make the math work out. Credit rating, you want that to be over 740 so you get the best credit terms. And then finally, verifying income, employment, and having all those statements available for your assets for loan underwriting. How do you do this? Well, first of all, your goal is to get the best terms and the best rate. So go to your current lender and ask if they'll refinance. Now, if they will, see those terms and check them against everybody else out there. Wherever you get the best deal, then go ahead and go through to refinance. Let's take an example. Let's say you had a $200,000 mortgage, 30 years long, at 5%. That payment is $1,074 a month. Let's say you can refinance at 3.5%. Now your mortgage balance is $191 after 3 years at 3.5% for 30 years. That's $858. There's a $216 savings. That's huge. Where's the hidden benefit here? Well, let's say you have a pesky $10,000 balance on a credit card, 5 years, and it's at 12%, $222 a month payment. Add the $216, that's $438 a month. Start applying the $438 a month every month, and you know what? Credit card debt's paid off in a little over 2 years. That means you got $222 extra for 3 years to pay off other debt, to save more money. What's the bottom line here? Over the lifetime of this loan, you have $40,000 interest expense savings, $2,800 in the first year, plus this extra $222 over almost 3 years. That's why it may make sense to go out and do a refinance.